Hello. How is everybody? Thank you so much for having me here today to talk to you. I appreciate it. I assure you, I was told to creep toward the stage at the end of that last talk. I wasn't just trying to hustle everybody off. Thank you for having me. I really appreciate it. My name is Chris Leonard, and I'm a business journalist and a reporter and an author, and I'm here to talk to you about the Federal Reserve Bank and interest rates. And before you try to quietly sneak out the door, let me assure you that if you had told me a few years ago I'd be out here talking about the Fed and central banking, the whole idea would have just sounded crazy. As a reporter, I like to cover topics that feel really important, that affect everybody's lives. I like to cover institutions and forces that shape our economy and our society. And I'll tell the story of how this happened, but back in about 2016, I didn't just become interested in the Federal Reserve, I really did become obsessed with it. And I wrote a book that's not just a history of the central bank, it's a really specific book talking about 1 decade of policy committed by the Federal Reserve between 2010 and 2020. And I'll just give it to you straight and quick. This decade of policy was unprecedented, radical, and highly experimental. And it has changed everything about our financial markets and our economy. And I sincerely believe it is one of the most important things for Americans to understand to really make sense out of a very strange economic environment where we live in today. And I think it's particularly important, of course, for the business community to understand this stuff, which is why I wrote this book. And so I'll walk through this and unpack what's happened over the last decade and what it means for where we are today. I was just talking with one of the board members, Stephen DeRosa, before this, and I described our economy today as like that cartoon where Wile E. Coyote runs off the cliff and the feet are still spinning and he's still levitating there, but you know that this can't last forever. And to be clear, I don't know which way things are going to break over the next 6 months and the next year. I think if anybody got up here and told you with confidence, here's what's going to happen with our economy, where the stock market is wobbling, bond markets are wobbling, inflation's at 6%, the highest it's been since the 80s. If somebody was to say to you, I know where things are going to be even in 6 months, that person is not shooting straight. We are in uncharted water, and the Federal Reserve put us there. And when I say we're in uncharted water, I don't just mean people like you and me don't know what's coming next or how to navigate this. I mean the leadership of the Federal Reserve does not have a roadmap right now. They are feeling their way through a dark room. I've interviewed the Fed Chairman Jay Powell, I've interviewed his predecessors Ben Bernanke, I've interviewed Janet Yellen. Let me please assure you, without sounding glib, these folks have no idea where we're going to go from here or if we're going to get out of this thing smoothly. So, okay, whatever. On that cheerful note, let me start from the beginning and explain why a relatively normal guy like me became obsessed with the Fed. So one of the things I love about journalism is you get to just meet all kinds of people. It's the best job in the world. You get to talk to people from all walks of life. So back in 2016, I was kind of minding my own business and writing a book about the Koch brothers, K-O-C-H, the Koch brothers out of Wichita. They've built this enormous private company called Koch Industries. And most people don't know this, but Koch Industries has this financial trading desk that rivals anything on Wall Street. And these folks are some of the smartest people I've ever met who do financial trading. And I was interviewing this guy who was a former senior person inside of this world of financial trading at Koch. And I like to let people talk to me anonymously because you really learn the truth that way. And I was interviewing this guy in 2016, and he's a really unique individual. Our first interview lasted 11 hours. I met this guy outside of a coffee shop. We were at a cafe. We meet with the breakfast crowd leaves, the lunch crowd comes and goes, the dinner crowd comes and goes. And at 8 o'clock, I'm like, I'm done. I can take in no more information. This guy felt a sense of urgency to explain to me what he was seeing in financial markets. And I think he wanted to talk to me about it because he really didn't have anyone to talk to. about what he was seeing. And here's what he told me, okay? He explained to me that the central bank, the Federal Reserve, is the most powerful institution in the world, economically speaking, because it can do something that nobody else can do. The Fed creates new dollars out of thin air. It's the only institution that can create a new dollar out of thin air. I'm going to walk through the mechanics of that in a second. But this guy told me that in the first 100 years of its existence, the Fed printed about $1 trillion. For folks who know about economics and all this stuff, this is the monetary base, or original dollars, $1 trillion, okay? And when you look at a graph, the Fed expanded the money supply. It printed those $1 trillion in this sort of slow and gradual increase over decades. And then between 2008 and 2015, the Fed creates $3.5 trillion. That's another way of saying the Fed creates 350 years worth of new money in about 4.5 years. The graph that describes this is a hill and then a hockey stick. And so even as like a ground level beat reporter like me, I recognized, wow, that's different. And what this guy was explaining to me was that this money was not a neutral force. This money was created inside the banking system on Wall Street, and it had a huge effect on markets. This money was like water going through a fire hose. Picture it this way, okay? The Federal Reserve was holding interest rates at zero for about 7 years while printing $3.5 trillion new dollars inside the banking system. All those dollars were out there chasing assets and driving up asset prices, frankly creating asset wealth. And an asset can be commercial real estate, art, tech stocks, junk debt. All these prices were getting elevated by what the Fed was doing, this guy told me. And he explained that everything would work fine as long as the Fed could keep printing money, but if it ever tried to stop, this house of cards would come crashing down. And I staggered out of that interview at 8:30 p.m. and went back to my hotel and started writing. And I'm thinking, this guy's got to be crazy. This guy's a crank. And I started researching. Okay? And what's at the core of this story, what this guy was talking about, is this Fed policy that is so perfectly named. It's called quantitative easing, which of course means nothing. It is a meaningless term that is meant to sound hyper-complicated. So the idea is that, mere mortals like us could never understand it. Quantitative easing is just the creation of new money at an unprecedented scale and pace. That's what it is. And I found, back home, kind of digging on this in the background, there wasn't a lot of great journalism about quantitative easing. There wasn't a lot of great journalism about what the Fed did after 2010. Okay, this is after the financial crisis. This is after all the headlines about Lehman Brothers and Goldman Sachs and the bailouts and the rest of it. This is about the decade from 2010 to 2020 when the Fed redrew the financial landscape. And there wasn't a lot of great journalism about it. So that's how I started getting into this and become obsessed with it. When I first read about quantitative easing, I read that this policy started in late 2010. And the vote to do it was taken inside this policy committee that runs the Fed. Okay, when you hear that, the Fed raised interest rates today, or the Fed cut interest rates today, it's this committee of 12 people that meet in Washington, D.C. that make these policy choices. They meet in secret for about 2 days, they make these decisions, and then the changes ripple out through the economy. So the Fed decided in 2010 to do QE, and the vote was 11 against 1. One person said no. So as a reporter, that number is really interesting. It's not a close vote. It's not 8-4, 11 against 1. So I'm like, who's the person that argued against it? Well, it turned out the one person who voted no was the president of the Kansas City Federal Reserve, this guy named Tom Honig. And his story ended up really making me decide that this was a book and a story that had to be told. Tom Honig, in short, is one of the most misremembered people in history I've ever come across. I started asking my contacts and friends, who's this Tom Honig? Why did he vote against quantitative easing? And everybody's like, this guy's a crank. This guy was an inflation hawk. This guy, back in 2010, said that if we do quantitative easing, it's going to cause rampant inflation, and that never happened. So Tom Honig was wrong to vote against quantitative easing. Well, luckily, we have this thing called the historical record that doesn't change based on the political winds. And when I talk about that Fed policy committee getting together for 2 days and debating and making choices, they actually transcribe all of their meetings. And so after a lag of 5 years, they release the transcripts. So, you know, if you've got the endurance to deal with it, you can sit down and read through the discussion for these 2 days of meetings about interest rates. And they're very smart, by the way, in how they release these transcripts. They'll release a whole year's worth of transcripts, which is several thousand pages. They'll release it all in one day. So imagine trying to be the Wall Street Journal reporter that day with, you know, 2,000 pages of Fed transcripts trying to find the news. It's a great way to make sure that we don't really go back and deeply scrutinize what happened, but I kind of had the luxury of time to do that. And when I went back and looked at these debates around doing quantitative easing in 2010, it was astounding to me, okay? This guy, Tom Honig, was the only guy to vote no. But he was not the only person to stand up against this policy. Inside the Fed, there was tremendous dissension and disagreement over whether they ought to do this. And this is important. These people who ran this committee recognized that this policy was profoundly risky. They were going to try to do this for short-term gains, but they would do so at the expense of building up long-term risks. And there were these debates inside. Nobody else voted no. Tom was the only guy who did. And then he ended up leaving the Fed and was misremembered as this guy who said, oh, it's going to cause inflation. In fact, the arguments he made were really nuanced and revealing. He didn't say it was just going to cause inflation. He said, if we do this, it's going to widen the gap between rich and poor. It's going to create massive asset bubbles that will eventually collapse and raise unemployment. And third, it's going to be a quagmire. If we start doing this, we're never going to be able to stop. And he was right on all 3 counts. So let's talk a little bit about what happened after that vote and what quantitative easing is. Okay, this is the mechanics and the stuff I love as a reporter, the plumbing of how the system works. Here's what quantitative easing is. Okay, the Federal Reserve has this trading desk in New York at the New York Fed, and I've toured this trading floor. It looks like any trading floor you might see at JP Morgan or Goldman Sachs. It's just this warren of cubicles with 20-somethings with fleece vests and coffee and their college pennants up and these, you know, and plants trying to survive in the anemic light. And what they do inside this trading floor is manipulate financial markets. That really is the truth. There's this one office in the corner where they execute quantitative easing. And here's what it is. The trader will sit down at this desk inside the trading room and call up a bank like JP Morgan and say, hey, JP Morgan, I want to buy $8 billion worth of treasury bonds from you. JP Morgan says, fine. JP Morgan sells $8 billion in bonds to the Fed, and that trader in the Fed clicks on the keyboard and says, look inside your reserve account, JP Morgan, $8 billion just appeared like that to fund this purchase. Quantitative easing is the replication of that transaction over and over and over again until you have created $600 billion out of thin air inside the bank accounts of these 24 select banks on Wall Street called primary dealers. Wells Fargo, JP Morgan, Goldman Sachs. Money out of nothing. Let's step back and look at this for a second. I said that QE started in 2010. You all probably remember, I'm older than some of the folks in this room, but 2010 was just kind of a gnarly time. The financial crisis had happened and it was past. Growth was weak, unemployment was high, and the Fed had done just about all it could do to stimulate economic growth, okay? The main tool you hear about the Fed using all the time are interest rates, okay? Right now the Fed is raising interest rates. It wants to do that when it wants to slow down the economy and fight inflation. And when the Fed wants to juice the economy and speed up the economy, the Fed will lower interest rates, okay? It's like engineers in the control room of a power station. They cut rates to heat up the power station. They raise rates to cool things down. That's how it's worked for a long time. In 2010, again, rates were at 0. The pedal was to the metal because we had just gone through this financial crisis. And the leadership team inside the Fed was debating what to do. They wanted to drive more economic growth. They wanted to bring down the unemployment rate, which is a departure, okay? We created the Fed in 1913 to do two specific jobs. The first was to create our currency, to create the United States dollar. That's what the Fed does. And the second was to step in and bail out otherwise solvent banks in the case of a bank panic. What the Fed did in 2010 was totally different. When interest rates are at zero and the Fed decides to do this quantitative easing, it's trying to do a jobs program. It's trying to become like the central engine of economic growth in America. That is not the role that the Fed has traditionally played. But the Fed decided to do it anyway, over the objections of Thomas Honig and about 4 other people inside that top committee. So the first round of QE in 2010 creates $600 billion. And just as Honig had warned, it wasn't enough, and the Fed couldn't stop. And so the Fed does another round in 2012 for like $1.6 trillion, flooding this money into Wall Street. Let me talk quickly about what this money did, okay? I have found that when you talk about this stuff, you really have 2 groups of people who examine Fed policy. You've got the PhD economists who run the Fed, like Ben Bernanke and Janet Yellen. The current chairman, Jay Powell's not a PhD economist. He's the first one since the 80s. But there's a team of PhD economists around him. These folks talk about monetary policy with sort of high-minded theory and economic models. And they say things like, quantitative easing will drive down unemployment and then we'll be able to withdraw it later. But then you've got this other school of people who actually trade in markets. These are the people that run private equity firms, hedge funds, stock traders. They operate in the shadow of what the Fed is doing, and they tend to talk about it in very unsentimental terms. And that's why this guy I interviewed in 2016 was kind of like frantically trying to explain to me, don't you see what the Fed has just done? When the Fed creates $3.5 trillion, at the same moment, it is keeping interest rates at zero. And by the way, let me pause here for a second. Those debates back in 2010, the Fed was debating first, gosh, do we keep interest rates at zero? And they thought they were going to do it for 6 months or maybe a year. Spoiler, it stayed at zero for 7 years. Totally unprecedented. They tried to raise it up a little bit. It's gone back to zero. We'll talk about what's happening now in a second. But the Fed kept interest rates at zero as it pumped all this cash into Wall Street. So picture what life was like for the people in that second camp I just described, the private equity people, the hedge fund people, okay? I talk about this with the metaphor of the seesaw of risk. When you're a hedge fund, okay, think of a 10-year Treasury bill as your safety, it's your savings account, okay? A 10-year Treasury bill is where you stash money to save it because Treasury bills are ultra safe. So for most of history, those rates were at like 4 or 5%. But the Fed yanked short-term interest rates down to zero, which in turn brought those Treasury bill rates a lot lower, down to like 2%. Okay, I know this sounds hyper boring. Let's just put it this way. Hedge funds didn't have anywhere to save money. The savings account was closed. At the same moment, $3.5 trillion comes rushing into the system. So if I'm a hedge fund guy, I have no incentive to save. I'm looking for yield. And you'll see this term all the time, a search for yield, a search for yield. This is what defined the economic climate on Wall Street during the 2010s, was the search for yield. All this money went into risky investments that people wouldn't have otherwise invested in. My savings account of the 10-year Treasury bill is closed. I can't stash money there. So I'm pouring money into corporate junk debt, commercial mortgage-backed securities, tech stocks for Tesla, for Facebook, emerging market debt, dollar-denominated debt for Chinese real estate companies like Evergrande that are just putting up giant empty high-rises. In a world where there's a search for yield, the cash goes flowing into all of this stuff and elevates those asset prices. This is what happened all through the 2010s, and it helps explain, in my mind, a lot about our economy over the last decade. The stock market doubles, the value of corporate debt doubles, the corporate bond markets double, corporate junk debt hits record levels. Meanwhile, wages are flat, productivity is flat, overall economic growth is anemic. We're printing money to drive up asset prices, and the real economy is limping sideways, which leads us to, January of 2020, when people start coughing and coming down with the coronavirus. The coronavirus was a once-in-a-generation economic calamity, okay? Things were going to be bad no matter what. But the Fed had created tremendous fragility in our financial markets. What I just described to you with the search for yield and all these prices going up is another way to say the Fed created asset bubbles across all these different sectors of the economy. So the pin of COVID was hitting the balloon of financial markets, and it created a financial market crash in March of 2020 that was worse than the crash of 2008. I walk through it in a little bit more detail in the book, but suffice it to say, like the most safe and liquid market in the world for treasury bills seized up and stopped. The Financial Times said this wasn't supposed to be possible, but it happened. The bill was coming due in 2020. There was a front page story in the New York Times talking about the time bomb of corporate debt that was about to explode. All these junk loans had been extended during the era of the reach for yield, and they were about to come crashing down. The Fed responded by printing 300 years worth of money in about 4 months this time. Hard to describe how radical the intervention was in 2020. Let me put it this way. When the Fed creates those new dollars, it expands its balance sheet. Let's just put it that way, okay? I talked about creating $1 trillion in the first 100 years. Then the Fed creates $3.5 trillion, okay? So now we've got $4.5 trillion. Right now, the Fed's balance sheet is $9 trillion. So we see this hockey stick spike, a plateau, and another hockey stick spike for the COVID bailouts of 2020. The house of cards was starting to fall, and the Fed stopped it. And it wasn't just the size of this bailout that was amazing, it was the scope. I mean, the Fed directly purchased corporate junk debt for the first time. I interviewed the people that constructed this bailout, and they were saying, we didn't do anything sophisticated. We just saw wherever there was a fire, and we pumped as much money as possible on top of it to stop the fire. So we emerge in 2021 with a Fed balance sheet that's $9 trillion, with the Fed purchasing assets of the like it's never purchased before. So this economy that I was describing of easy money during the 2010s has now been quadrupled down upon by the Fed. Okay, that leads us to where we are today, which is crazy town, to put it in a short phrase. And I'll explain why I say that in a second. Let's just look at life in 2021. Okay, Jay Powell had done stuff that frankly people in the financial community thought might not be totally legal. For example, to buy corporate junk debt. It was extraordinary, but it was done. Okay, the dust settles, COVID's over, here we are. If the Fed had about 15 to 20 years to kind of try to slowly unwind these policies, we would have been totally fine, probably. One of the things Tom Honig warned about is the quagmire of printing all this money. What he said was once you start, you can't stop. And he was exactly right. And so here we are in 2021, and the Fed's position is okay, we're going to try to really slowly back this out. We're going to try to take our balance sheet from $9 trillion. Forget about the good old days of 2007 when the balance sheet was $1 trillion. We're going to try to get it back to the crazy quantitative easing days of 2015 when it was $4.5. And that's probably going to take 5 to 10 years. Again, I can't overstate, here's the problem. when you start unwinding this stuff, the metaphor I hear all the time on Wall Street, and I'm sorry, but it's like taking heroin away from the jungle. The sickness kicks in pretty quickly. When you take away this easy money, markets react quite negatively. Stocks drop. The cost of borrowing rises, sometimes a lot faster and out of our control than we want. The effects are pretty ugly. So in 2021, the Fed's saying, okay, we got time. Because the Fed has enjoyed this wonderful luxury of many years of not having high price inflation. Okay, what I've been talking about this whole time is asset inflation. Stock market's going up, bond market's going up, assets rising, double-digit levels every year. But we never saw price inflation during the 2010s. Price inflation was really low. And you know who was totally caught off guard by that was the Federal Reserve itself. The Fed estimates right now that inflation is going to be at 3% at the end of this year. If that's right, and if the Fed is right, it's only because the Fed was entirely lucky. Because I've gone back and read through their internal forecasts going back 10 years, and they have been wrong every single year in guessing where inflation is going to be. They've always thought it was going to be stronger than it was. It was always came in weaker. And then they thought it was going to be weaker. And in 2021, we have 5% inflation, 7% inflation, then 9% inflation. This was really bad news for all of us. Because, look, inflation is bad on its own. It really puts a tremendous strain on the middle class. That's usually who's hurt the worst. But it also forced the Fed to do something the Fed really didn't want to do, which was to jack up interest rates. Because the Fed's one job is to fight inflation. It cannot have credibility if it allows inflation not just to remain at 9%, but to become embedded and to grow. So I describe it as like having a fire at your back, okay? The Fed was forced to start raising interest rates last year because of 9% inflation. In June of last year, interest rates were near zero, where they've basically been for about a decade. Right now, interest rates are almost 5%. What happened last year was not an increase in interest rates. It truly was an interest rate shock. Okay, interest rates aren't as high now as they were back in the early 80s when the epic, legendary Fed Chairman Paul Volcker raised interest rates to fight inflation. Interest rates back then were like 11%, okay? But last year, the Fed raised interest rates higher and faster than any point since World War II. It's an interest rate shock. And here's what really matters, I think, to all of us, is that right now we've got this chairman of the Federal Reserve named Jay Powell, and he is going out publicly and saying one message really clear. He's saying, folks, interest rates are going to hit 5% or higher, and they are going to stay there until inflation is 2%. Mark my words, I am dead serious. He has said this again and again and again, and you will see these stories in the Wall Street Journal. Wall Street does not take him seriously at all. The betting market or the derivatives market on interest rates is at a divergence from what Jay Powell says the interest rates are going to be. This is crazy town. This is what I'm talking about. The markets say the interest rates will be at 4.5%. Jay Powell saying, no, I'm dead serious, folks. They're going to be at 5%. And that's what leads us to the disconnect of where we are today. This is the central risk to our economy right now, is that the Fed is going to have to keep interest rates elevated at a level that Jay Powell is promising they're going to do. The best case scenario for all of us is that inflation just falls dramatically and sharply. Okay, it's at about 6% year-over-year gains right now. The Fed says it'll be about 3% at the end of the year, maybe lower. Let's really all light our little votive candles with Jay Powell on the candle and hope that that's true, because that would be the best possible outcome, because then the Fed can start to lower rates again. But if that's not true, if there's persistent inflation for markets like labor and wages and oil and fossil fuels, which, by the way, there is persistent inflation in those markets, it means the Fed's got to keep rates high, okay? It means Jay Powell is dead serious. Well, what does that mean if interest rates are 5%? That doesn't sound crazy. It doesn't sound scary. You know, historically, rates have been between 3 and 6%. But that decade I just described was 10 years of 0% interest rates, coupled with massive money printing. I interviewed that guy, Tom Honig, who voted against this. I interviewed him several times for the book, and he put it really well. He said, you can't have a decade of 0% interest rates at no cost. The entire financial world reorients itself around that zero rate, okay? You can raise it up again, but the world's going to change. There's going to be pain. There's going to be consequences. If interest rates stay at 5%, there are trillions of dollars in assets that were created in a 0% world that are going to be reassessed. Another way of putting that is the price of corporate junk debt, tech stocks, the S&P 500, mortgage-backed securities. It's all going to downwardly adjust in a large and dynamic event, as Jay Powell once described it, which is fancy terminology for crash. So here we are today with rates at 5% from an interest rate shock. It has not had time to bleed out into the world. That I can tell you with total confidence. We will discover what life in a 5% world looks like over the next year to year and a half if those high rates persist. A guy who talks to Jay Powell told me that Powell said that this is going to be like landing a 747 on an aircraft carrier to pull this off. And I said, that's just another way of saying you're going to crash a 747. Because it can't be done. And, you know, there's a school of people hoping that we're going to have this smooth landing, but that will be like threading a needle. So on that totally cheerful note, I will open it up for questions. Or just drinks, I don't know. Yeah, where do I invest? As a print reporter, my vast pools of capital. That's what everybody asks me a lot. And so I'm this is the worst answer ever. I'm a hyper conservative. I've got my 401k, I don't touch it. I know enough to know I never try to outsmart the market. The people who really know what's going on don't talk about it publicly. They play their cards close to their vest. And I just try to stick to my knitting and work hard and put my money in a 401k and be conservative. Super unsatisfying. Yeah. Yeah.
In all of your research, what correlation is there between the Fed's action and local politics?
What correlation is there between the Fed's action and the world of politics? I'll tell you, actually. The Fed is the greatest enabler of fiscal undiscipline in the world. One of the people I interviewed for the book was a former governor of the Fed named Betsy Duke, who's a former banker. She sat on that committee of the 12 people. And she said, everybody loves the Fed because we can just create money out of thin air. You don't have to tax anybody. You don't have to cut any spending. It's like free money. What politician doesn't love that? And this is really important. The Fed executes quantitative easing mostly by purchasing treasury bonds. I kind of just blew right past that, but it's very important. I just can't explain how crazy this whole situation is. I mean, that first round of quantitative easing was $600 billion, and it was controversial. I mean, there was news stories about it and all this stuff. By 2021, the Fed was doing $120 billion a month in quantitative easing just as normal policy. Just the fire hose was open out into the street. But to do that, the Fed was purchasing treasury bills directly. So think about it from the point of view of Uncle Sam and the United States Treasury. The way we borrow money is by selling treasury bills. And the Fed is always there to buy, or has been for the last decade. And that helps keep our cost of borrowing really low, and it helps us sell our treasury debt. So this is another reason why we're at kind of a touchy point right now, economically, is that Jay Powell is saying, not just am I going to keep rates at 5%, I'm done buying treasury bills. Quantitative easing is over. We're going to do quantitative tightening. So now the Treasury has to go out in this market and sell its debt without its biggest buyer. During 2021, the Fed was buying up to 80% of all US debt that was issued every month. That's a big buyer, 80%. Gone now, probably. So politically, the Fed has been a bottomless reservoir of new money to support whatever Washington, D.C. wants to do. And that era seems to be drawing to a close really quickly. Amazingly, the amount of money we spend on interest every year is almost equal to our defense budget. The gargantuan, gigantic defense budget of $780 billion a year. What we spend on interest is almost equal to that. In a year and a half, it's probably going to surpass that. So, this is why people don't invite me to talk that often. In the back.
How at risk, given that we've run up the credit card and now we're jacking the rate on our own credit card, how at risk is our world currency reserve status?
Yeah, that is the multi-trillion-dollar question. How secure is our status of having the United States dollar be the global reserve currency, which is its whole talk on its own? We enjoy an exorbitant global privilege. Everybody banks in the dollar. Everybody's savings account, and by everybody I mean like foreign central banks, their saving account is in the dollar. This gives us such a privilege to issue debt and to print new money because we're not subject to harsh market reactions that other currencies are subject to, like even the British pound is subject to market forces. As we saw, we were just talking about this last year. You know, they tried to do some pretty standard US policy of raising spending or cutting taxes in England, and global markets recoiled. Said, no way, we're not going to do that. That's totally irresponsible. You're going to have to pay more money to borrow. That really did happen in England, and the Wall Street Journal said on the front page, this is only supposed to happen to emerging markets, but it just happened to London. So it doesn't happen to us because we're the global reserve currency. And your question is, how secure is that? As I say, there's like this red line beyond which the world won't want to use the dollar as a reserve currency. And when we cross that line, it's going to be the only thing anybody ever talks about all day long. It's going to change our way of life. We don't know where the red line is, but we seem determined to find it through these policies of easy money and debt issuance. And I would highly recommend Googling this Credit Suisse analyst named Zoltan, Z-O-L-T-A-N, Pozar. And I could give you the name after the thing, but very smart guy who understands the plumbing of the financial system. And he's been pointing out how our global economic competitors, put it that way, are starting to create alternatives to the US dollar as a reserve. China, just, Chairman Xi was just in Saudi Arabia with the head of MBS, the Crown Prince. I think he's the Crown Prince, whatever his title is. They're going to price oil in yuan. Okay, this is happening around the edges. We're the least bad story in currency markets right now. And so that advantage remains and is strong. But as a humble reporter, it seems to me that we're not in a position to act with like impunity or extravagance when it comes to borrowing money or being fiscally irresponsible. We're kind of at this point where we need to start taking seriously this idea that there might not be a bottomless global market for our treasury bills, and that there might be like a threshold of tolerance for using the dollar as a reserve currency. Great privileges need to be treated with great respect, for what that's worth. Yes?
Yeah, hi. Chris Walton, Parkway. Question about the target inflation rate. So I've always felt 2% like completely arbitrary, made up. Like, why not 1.5? Why not 2.5? And my question to you is, based on your conversations with those guys, like, do you think they're hell bent on staying hawkish until we get to 2%, or do you think that maybe they'll just settle for a higher target inflation rate, 3%, set that as a new target, and call it? What's your opinion there? Thanks.
Great question. I hope everybody could hear that. It's like, you know, Jay Powell says he's hitting for this target inflation rate of 2%, which you said is kind of a made-up number, arbitrary. But, you know, on the flip side of the coin, it's also, you know, a total illusion and fake. It's a joke. And your question is a super important one. Are they going to really put the pedal to the metal until they get to 2%? Is that serious as a target? Or do you think that things might get so bad that they settle for 3%? And all of a sudden they say, hey, 3% is okay. Because we got to remember, the tension is very serious and the stakes are very high. In the words of Jay Powell himself, previously inside the committee, in 2012, he was talking about creating massive financial crashes by tightening. He's saying, you know, by doing this, we are leaving ourselves at risk for a massive financial crash. If rates stay at 5%, that's what could totally be on the horizon. That's not me, that's Fed economists. I was just interviewing people about this 2 weeks ago. Jay Powell would answer your question by saying, I am dead serious. When I say 2%, I mean 2%. And I didn't mean to be glib. You're right. It is a completely arbitrary number. There's no magic notion to 2%, and the whole kind of origin of that term is murky and arbitrary. But okay, fine. He said 2%, and that's kind of seen as a safe zone. Wall Street is betting that there's no way that the Fed will intentionally create the kind of adverse financial conditions that will probably happen if we have 5% rates for a year and a half, and that they will back down and accept 3% inflation. And my honest answer, I think Jay Powell doesn't even know. I think Jay Powell doesn't even know. I think he means it when he says he's going to hit 2%. But as this story unfolds, there will be tremendous pressure to yield. And there is definitely a very solid school of thought that thinks the Fed's most likely pathway is to accept higher inflation, which, by the way, reduces the debt burden. You, quote, inflate away the debt. It punishes the middle class. But what else is new? And so they might allow that to happen. And my sincere answer is, I don't think even Jay Powell knows which way it's going to go. Sorry, okay, yeah.
Now that people like you are shedding light on these actions of the Fed, and the 1% is no longer on the Fed, are there other champions, either within the Fed or outside of it, who are fighting against this or trying to speak some rational talk to them?
So yeah, the question is, here we are today in 2023, the guy who voted against this has been out of the Fed for a long time. Are the people inside arguing the other side of this thing? And the answer is no. There are, okay, gosh. The Fed's leadership committee of 12 people is built in such an interesting way, and I won't go into the weeds, but there's these politically appointed people at the Fed called governors, okay? There's 7 of them. And then you've got all these regional bank presidents around the country. They come together and they have this committee of 12 people. But the regional bank presidents rotate through. What I'm getting at is the governors have a veto-proof vote on that committee. And they always work in lockstep together. Betsy Duke, the former governor, told me on the record how they would have their vote agreed upon before the meeting started. And that's just how it works. And there's not significant division within those governors right now. And honestly, I really feel like they're trapped by the last 10 years of policy. The whole idea of of undoing quantitative easing isn't really on the table. Now, as soon as I say that, I've got to acknowledge, like Jay Powell said, that they are going to tighten significantly now that price inflation is here. They're going to tighten significantly, which is a reversal on the last 10 years. But in terms of the theory of monetary policy, and was it the right thing to print all this money through quantitative easing, there is very little dissent on this top policy committee. Gosh, last year, and then, in 2021 in November, there was this competition to be chairman of the Fed between Jay Powell and a governor named Lael Brainerd. Their difference between them on monetary policy was non-existent. No daylight. Same exact position on all this stuff. And I mean, I've been a huge down on most of this talk, but I guess the upside is that the policy of money is a policy that should be debated democratically. We created the Fed to be kind of insulated from voters. Fed leaders are not elected, they're appointed, they serve these long terms. And that's kind of removed these conversations from the retail realm of politics. And I think that a lot of this upheaval hopefully will change that. And I would love to see this stuff discussed on cable news to the same degree that we talk about, XYZ political issue between two elected politicians, because this stuff is really important. Yes?
Yeah, so it's really interesting that the story that you just told us is eerily similar to the FTX and Green Free and Alameda story, and almost makes the case for Bitcoin. It's curious if you've done any research on it.
So you say the story is fairly similar to the FTX story and to cryptocurrency and what's been going on with that, which is so interesting. And Stephen, if I go over, could you just raise your hand? Is that the hand? I wasn't just doing that to get out of talking, but honestly, I could I will be here afterwards if anybody actually wants to talk more about this. Here's what's so fascinating to me about crypto. Monetary policy needs to have discipline. That's why we shielded the Fed from voters so they could make the hard calls. That's why we had the gold standard. We have replaced the discipline of the gold standard with the wisdom of the Fed's leadership committee, the FOMC. And we said, okay, you folks need to really have the discipline to do this right. The whole idea behind crypto is that the gold standard is an algorithm, like only so many coins will be created, and it's a disciplined form of currency. I think that was the kind of theory. This is solid money. But what happened is during the era of reach for yield, crypto became another supercharged asset that money was pouring into. And so you see the prices go like this. And I think it's safe to say it was one of the first canaries in the coal mine that really started to collapse. And what crypto is going to mean is going to be watched out, I think, over the next couple of years. But I don't know that much about crypto. I never reported on that. I reported what I call, government currency, the dollar. But it was definitely a supercharged, overheated asset.
Just to clarify.
Yeah.
Crypto, so you would.
See, my ignorance is exposed. I would not have even have differentiated. So there's a difference between crypto and Bitcoin. And on that note, I will say thank you so much for listening. I'm really